Imagine opening your trading platform tomorrow morning with one rule. You only get 2 trades. Not 2 winning trades. Not 2 trades and then one more if you lose. 2 trades. Once they're gone, you're finished for the day. Suddenly, that setup you would normally click without thinking doesn't look quite as attractive. You hesitate. You look again. And you ask a question you might not normally ask. Is this really worth one of my 2 trades? That question changes more than it seems. But it also creates a completely new psychological problem. Because what happens if your first trade loses? What happens if both trades lose before the best setup of the day appears? And what happens when you've used both trades, but you're convinced the third one is going to work? Let's imagine a hypothetical trader with a $10,000 account. Normally, this trader doesn't have a daily trade limit. Some days they take 3 trades. Other days 5. And on a frustrating day, maybe 8 or 10, they begin the session with good intentions. They tell themselves they'll only take high-quality setups. But there is no clear stopping point. So today, they try something different. Maximum 2 trades. Before the market opens, the rule feels easy. Then price starts moving. A possible setup appears 10 minutes after the open. Normally, the trader might enter immediately. But now there's a cost that didn't exist yesterday. Not a financial cost. A psychological one. Taking this trade means using half of today's opportunities. So the trader looks again. The setup is decent. But not great. Yesterday, decent might have been enough. Today, the trader waits. 20 minutes later, another setup appears. This one matches the trading plan much more clearly. The trader enters and risks a hypothetical $100. The trade loses. Now something interesting happens. The account is at $9,900, but there is only 1 trade left. Without the limit, the trader might immediately start searching for a way to recover that $100. A new candle forms. Another possible entry appears. The familiar thought arrives. I can make it back. But now that thought runs into a boundary. 1 trade left. Suddenly, revenge trading has a price. If the trader wastes the final trade emotionally, there are no more trades today. So instead of immediately clicking, they wait. And this is where the 2 trade rule becomes psychologically interesting. The number 2 isn't magical. There's no universal psychological law saying 2 trades is the perfect amount. What matters is that the trader created a decision boundary before emotion entered the situation. Psychologists call a related idea an implementation intention. In simple terms, instead of saying, "I'll try not to overtrade today," you create a specific rule in advance. Something closer to, "If I've taken my second trade, then my trading session is over." That distinction matters. "I'll try to be disciplined" requires you to make another decision later. And later might be exactly when you're frustrated, excited, afraid of missing out, or trying to recover money. A predetermined rule moves part of that decision to an earlier moment, when you're calmer. Now let's go back to our trader. They've lost the first trade. 1 trade remains. An hour passes. Nothing looks good. And now a different emotion appears. Impatience. The trader begins thinking, "I can't finish the day with only 1 trade." Notice how strange that thought is. The market never promised 2 good opportunities. But once the trader has a 2 trade limit, they may begin feeling that both trades should somehow be used. And that's the first danger of this rule. A maximum of 2 trades does not mean you must take 2 trades. Maybe the correct number today is 2. Maybe it's 1. Maybe it's 0. If you turn the limit into a quota, the rule designed to prevent overtrading can create forced trading instead. So the real rule isn't, "I must take 2 trades." It's, "I cannot take more than 2. That's a very different mindset. Now imagine the trader waits. Eventually, another setup appears. This one meets the plan. They take the second trade. It makes a hypothetical $180. The trader is now up $80 for the day. 2 trades are complete. Session finished. Simple, right? Not necessarily. Because 15 minutes later, the cleanest looking setup of the entire morning appears. Price reaches exactly the area the trader had been watching. Everything seems to line up. And now the trader starts negotiating. This setup is too good to miss. The rule was really meant to stop bad trades. This one doesn't count. I'll reduce my size. Just one more. This may be the most important moment of the entire experiment, because the real test of a trading limit isn't whether you can follow it when nothing is happening. It's whether you can follow it when breaking it feels completely justified. The trader now has two competing ideas. The plan made earlier says, "You're finished." The opportunity in front of them says, "But what if this one wins?" And here's the uncomfortable reality. It might win. The third trade could be the best trade of the day. You could follow your two-trade rule, close the platform, and then watch the market move exactly as you predicted. That doesn't automatically mean the rule failed. This is where traders can confuse decision quality with individual outcomes. Imagine you break the rule. You take trade number 3, and you make $300. What did you learn? If you're not careful, you might learn, breaking my rules works. That's dangerous. Because next time, the third trade becomes easier. Then maybe the fourth. Eventually, the limit isn't really a limit. It's a suggestion you follow only when you feel like it. Now reverse the outcome. You take the forbidden third trade and lose $200. Suddenly, you tell yourself, I knew I should have stopped. Same decision, different outcome. That's why evaluating your behavior only by profit and loss can be misleading. The better question is, did the decision match the process I chose before I knew the outcome? But there's an even deeper benefit to limiting your trades. It can reveal why you're trading. When unlimited trades are available, you may never notice how often you click because you're bored, or frustrated, or afraid of missing out, or trying to recover a loss. But when you only have two opportunities, every impulse becomes more visible. You see a mediocre setup and want to click. Why? You lose your first trade and immediately want another. Why? You use both trades and still can't close the platform. Why? The limit acts almost like a mirror. It doesn't automatically fix your psychology. It exposes it. And that may be more valuable than the number of trades itself. So how could someone use this idea without turning it into another rigid trading myth? First, treat two trades as an experiment, not a promise of profitability. The goal isn't, 2 trades will make me profitable. There is no guarantee of that. The goal is to observe what happens to your decision-making when opportunities are limited. Do you become more selective? Do you feel more FOMO? Do you force your second trade? Do you immediately want to break the rule after a loss? Those reactions give you information about your behavior. Second, define the rule before the session. Don't decide after trade number 2 whether the limit still applies. Decide what happens in advance. For example, if I complete 2 trades, I close the trading platform for the session. Research on implementation intentions suggests that specific if-then plans can help people translate intentions into behavior. That's more concrete than simply saying, I'll try to trade less. Third, don't turn the maximum into a target. If no valid setup appears, 0 trades can still be consistent with the plan. You aren't being paid for clicking the mouse. A trade slot doesn't expire like a coupon you need to use. Fourth, journal the trade you wanted to take but didn't. This is where the experiment becomes useful. After reaching your limit, write down every additional setup you felt tempted to take. Not because you should have taken it, because you want to understand the trigger. Was it FOMO? Revenge? Boredom? A desire to finish green? Overconfidence after a win? Then review those situations later when the emotion is gone. You may discover that your biggest problem isn't identifying setups. It's deciding when not to participate. And finally, judge the experiment over a meaningful sample of sessions, not one afternoon. If you try a 2-trade limit once, and the third setup happens to be a huge winner, your mind may immediately conclude, this rule cost me money. But one missed trade tells you almost nothing about whether the boundary improved your overall decision process. The purpose isn't to catch every winning trade. That's impossible. The purpose is to see whether a predetermined constraint changes the quality of the choices you make. So imagine tomorrow morning again. Your platform opens, the market starts moving, and you know you only have 2 trades available. The first question is no longer, can I trade this? It's, is this worth trading? And that small change can reveal something important. Overtrading isn't always a problem of not knowing what a good setup looks like. Sometimes it's a problem of having no clear reason to stop looking for the next one. A 2-trade limit creates that stopping point. But the number 2 isn't the lesson. The lesson is pre-commitment. Making certain decisions while you're calm so you don't have to renegotiate them when you're emotional. Because real discipline isn't proving that you can resist temptation every 5 minutes. Sometimes it's designing your trading session so you don't have to make the same emotional decision over and over again. And if limiting yourself to 2 trades makes you extremely uncomfortable, pay attention to that feeling. Because the discomfort may reveal exactly what trading has been doing for you psychologically. Maybe you're not only looking for good setups, maybe you're looking for action. And that's an entirely different problem. Because boredom can make a perfectly disciplined trader start seeing opportunities that aren't really there. And that's what we'll look at next.